All right, so welcome to another video. Today, what I want to do is go ahead and share with you some insight on McDonald's. We're going to do an Iron Condor strategy. So we're going to go ahead and check that out. Earnings have been released, and there's a handful of things you could have done when it comes to trading Iron Condors for earnings. But in this video, what I'm going to do is I'm going to just share with you another options idea and options play. I'm not recommending anything like right here. I'm just giving you some personal insight and definitely just giving you some thoughts to think about. Okay. Definitely check out our Discord channel if you're brand new. That's where I post some announcements, some charts. You can check that out. And you can also take a look at our website as well at tradersfly.com. There's a lot of live classes that we deal with when it comes to options, like trading singles the right way. This class is really intense, you know, how to not lose theta or money trading singles. You know, so there's a little trick to that, and how to adjust option strategies as well. So it's like 10 hours long on each one of those classes. Anyway, let's kick things off with McDonald's. And a lot of people, what they think about is they're always looking at, you know, doing an Iron Condor, and they do it kind of non-directional, but condors can be directional. So looking at McDonald's stock, I was just looking at Pinterest, but let's go with McDonald's stock right here. You can see revenue tops estimate fueled by price hikes. So yeah, we're more inflating. So a burger instead of $2 will be $50 eventually. That's just the nature of life and printing money. But what's going to happen is if we look at McDonald's here, you can see we're kind of holding this price level around 250. So this is pretty nice, right? But let's say you believe in McDonald's. Again, I don't know your personal opinion. Your opinion might be different than my opinion. But let's say you believe in McDonald's. You're a long investor. You want to go bullish on it. You know, you could buy a single call option, but a single call option is very expensive and you got a lot of negative theta that goes against it. So what I could do is actually go bullish with a vertical, but a vertical is also a little pricey. And if I get the direction wrong, it can bite a little bit. So what you could do is do an Iron Condor then, non-directional, right? So you could do something like an Iron Condor here, or in other words, it would be like this, and you put it at the money, and it can go this way or that way. But again, now you got a problem. What if the stock explodes? So if you're slightly bullish, one way to kind of reduce the capital is to do a bullish Iron Condor. So here's how this would look and the setup for you. So I want to share with you this idea of a setup. So I'm going to go ahead and go about 22 days out in McDonald's. If I go too short, I got a little price risk. If I go too long, you know, it could be more volatility. So 22 seems pretty good for this strategy. So what I'm going to do is actually, instead of selling the put side over here, I'm actually going to buy or kind of sell this one over here, but do it kind of closer in. So I'm going to sell kind of the in the money stuff. In other words, I'm actually going to buy it. So that way I don't have the obligation and so on. So I'll buy this and I'll sell one over there. So that's what we're going to do to construct this spread trade. Okay. So here's what we'll do. We'll go ahead and I'll break this up for you in two ways. So we'll go in and I'll buy one in the money. I'll go to about a 70 delta here. If I go too deep, it'll be a little expensive. So I'll just buy one here in the money or out of the money. I could do the put side. It's fine. It's just a personal preference. I'm just showing you a different variation of it. I could just buy one vertical over here. And now that I buy this vertical, I'll analyze that trade. So you can see I've bought one in the money. So it's like selling puts, except this time I'm just going in and dealing with the call side. And I want to do that because if it just keeps going, maybe it's just all calls. If you want to do all puts, fine, totally up to you. Not a big difference, but I'm just showing you the variation. Because what you could do eventually as you get better at these is actually do a bullish Iron Condor even way further out for a later pop. Like if the stock is trending really well to the upside, you could do something like that, which I'll show you in a second here. All right, so now what I'm going to do is I'm going to go out of the money and I'm going to do something, you know, about a 10 delta right here. You know, you could do a 5 if you want, but that just kind of helps hedge off a little bit, maybe about $100 worth, $50 worth on the 270, 275 level. And we're going to go ahead and sell that one, right? So we'll go ahead and sell a vertical here and I will analyze that trade. And we'll go 275. So $35 worth. So you can see what's nice about this is now I've got much more range on the upside. So if the stock does keep going higher, I've got more room over there. Now, here's the little bit of the issue. What if you want to be even more bullish? Well, what you could do is now go another 5 points on the call side, right? On the one you're buying. Now you've got an at the money vertical and you've got more range there. Okay. So I could go in and let's just bump it up to 10 contracts here. Let's do 10 contracts on this one. And now what you've got is much more room and range there, and you're slightly protected from the 10 over here. So these 10 kind of hedge you a little bit by about $340. They kind of hedge off some of that risk. And that's a nice way of kind of doing it, is that, look, if it pulls back, you're not just exposed with these verticals. Yeah, that it does chew up about $2,900 worth of capital, but the other $300 that you have, what's really nice about it is now you're down to $2,500. So if you want to at least use less capital, this is the way to kind of approach it. And now you've got some room. If you want to save a little more capital just in case, you could go bring this in even further on the right side. Unfortunately, the problem with doing this is now if it actually does explode to the upside, you could overshoot it. So in that case, you might want to say, okay, let me reduce the number of contracts there. And now you've got kind of 6 contracts working against you, but they're more powerful contracts. But this way, the upside is not as capped or dangerous. And you can see even then, 2,300. So you're actually, by bringing it in on the right side, you're now using 2,300 or 2,200 instead of that 2,900 earlier. So by doing this one, the extra vertical, now I'm at 2,200. And it's just because it's more powerful, but I'm bringing it in even though I'm doing less contracts. And now you don't have as much of that upside risk. If it does explode or pop to the upside, you're actually pretty good. So this is kind of a nice way of doing it, that, hey, I'm protecting myself with this iron condor a little bit. And if you want to go even further, you could bring it in even more. But now it's starting to function and behave a little more like a butterfly. There's a little bit of that trade-off. You're starting to get into like a broken wing butterfly at this point. Yes, you do use less capital, but that's still okay. So if you did this trade setup, if it does explode too far, your break even is almost zero on the upside. So you really can't lose money. And what's nice about this is if it does keep going higher, 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 now what's going to happen is you'll turn into a negative delta. And when it pulls back, if it overshoots, you're going to make even more money from there. So that's kind of a cool way to approach this trade, or that strategy, is that doing an iron condor on a stock that you believe is going higher, but just doing it bullish can reduce the capital you have on the trade. It can help even protect you if it goes to the downside, and you can really tweak it based on your own bullishness to it. You could start out with kind of 10 contracts and be a little more balanced. And later, as it starts going up, you can just kind of reduce that size or lot a little bit more at a time. So anyways, definitely take a look at something like this. If you're kind of looking at doing something bullish, an iron condor doesn't have to be just at the money, or it doesn't have to be non-directional. It can be slightly directional like this. You're just tweaking the trade based on what you see in the marketplace and modifying it to personal needs. And on a stock like McDonald's, where now you're starting to kind of trend a little to the upside, and you see that we're getting a little bit of a not mega support, but look, obviously that stock can go down. Look, but you're starting to see a lot of trades right here. And if we are holding support, and if you believe you'll continue to move higher, then doing something bullish like that is still a little bit more cautious than just doing a straight up single or doing buying straight out shares. You're just much more cautious. And if it kind of even just hangs around there, what's going to happen is you still get a little bit of theta. So, that theta will start to decay in your favor and will help you out, even if it just kind of hangs around this range. So that's the way I would look at something like this, is just, look, I'm trying to be a little more careful in these kinds of conditions. If I was really, really cautious, then I wouldn't, and I wasn't as bullish, then yeah, I wouldn't do something like this. But if you're bullish on a stock, that's the time to do it. If you're bullish on a stock, but you're slightly cautious, then you could do kind of a bullish iron condor, because you're not as aggressive as a vertical is. And you're not risking as much as maybe selling puts way out here, because you have to put way more capital out here. This one, you use a lot less capital, but you need the stock to move a bit. So that's a bit of the trade-off, is you need that stock to move. So anyway, this is an interesting setup. If you've never done one of these bullish iron condors before, take a look at it. They function a bit differently. They're good for momentum trades, trades that keep going. And it's a starting point where you can actually just wait for that momentum to kick in. Like if the stock is just stalling, like let's say a stock is just kind of going this way, and then later it moves, you can hang out there for a while. Unlike a single option, you just can't do it. In this trade, you can do it. You can just hang out, and then later it starts moving. And by then, this white line and this curve will start to puff up a bit, and it kind of will get into this zone. You can just take it off, reset it, do another one, time and time again. So anyway, I hope that helps, gives you an idea for another strategy play here. Just something to look at and think about. You could do them, you know, between 15 days, you could do them 30 days, 25 days, 45 days. But just keep in mind, the longer you do it, the bigger negative vega you'll get. And if you do them too short of a duration, you'll have much more price risk because you'll have to be a little tighter, or you just don't get enough credit from the spread, or it'll just be a little more expensive because you don't get as much credit on these spreads on the outside. So anyway, I hope that helps. Truly appreciate you sticking with me and joining me. You know, feel free to check out our website, grab some freebies if you like, right here down below, and I will see you in the next video and update.